I guess, Bill, congratulations on retirement. I want to get to the track record, the challenges you've had at Janus Henderson. But how did you get here? How was this decision made in the last number of days? Did you make this unilaterally? Did you make this with Janus Henderson management?
Well, no, I did it unilaterally and in combination with my family and my partner, Amy Schwartz, who I'm having so much fun with. You know, it's been almost a half a century of watching screens, Tom, and waking up in the middle of the night to check Asia and Europe, and then Tom Brady equivalent years. That's a long time. I've got a few Super Bowl rings along the way to look at, and it's time to enjoy myself and enjoy my family.
Within this is the catalyst of outflows of funds. Was it harder to manage the Janus Unconstrained Fund given the repeated and chronic outflows that you've seen over the last number of quarters and even years?
Well, not really. I mean, half of the fund is mine, and I haven't taken any money out of the fund. Others have, as you've mentioned. I look back on it, and the performance on the Unconstrained Fund in the past 4 years with Janus has been unsatisfactory, no doubt, but still positively positive in normal and nominal terms. What I'd like to mention, though, is I've managed some total return accounts, what I'm famous for Janus, and they've outperformed like the old days at PIMCO, 100 basis points over, and actually outperformed PIMCO. So maybe I should have stuck to total return and been a little more constrained. This
is a really important point, folks, and that Mr. Gross has a number of ideas going here, including fighting the fixed income battles, the fixed income wars of mutual funds. But I was talking with our John Gittleson in Los Angeles, Bill, and within the unconstrained model, the prospectus model of this phrase unconstrained, what did you learn about the pros and cons, the difficulties of this phrase unconstrained?
Well, unconstrained has come to mean basically go anywhere. The total return concept that I developed was really developed on a concept of measured risk taking. It's what I learned in the days of blackjack. You didn't put a lot on the table. And so, for the past 3 or 4 years, the negative trade for unconstrained has always been Germany versus the United States in terms of a spread. 10-year German bunds started out in my portfolio at 190 basis points over, and they're now 250 plus over. And so that's been it's been the big decider, and probably one in which I shouldn't put too many chips on the table.
Well, this is critical, Bill, and this goes to the hedge funds and so many underperformances of hedge funds, depending on whatever you want to look at with the statistics. Was the underperformance that you faced in the last year with Unconstrained, was it because you were not diversified? Is it the phrase unconstrained gets you into a focus where the bets are too big, to go back to Ed Thorpe?
Yeah, I think it did for me, and perhaps for other unconstrained funds too, if only by the nature of the term. The old Ed Thorpe terms, the gambler's ruin concept, basically said you could only bet 2% of your total capital. And certainly I had positions in Unconstrained that were significantly more than that, especially the German-U.S. Treasury trade, and that probably was too much. But it was an unconstrained portfolio. Investors were expecting hedge fund types of returns of 5 to 10%.
Well,
and, for a while there, it was only 1 to 2%, and that was unsatisfactory.
It was unsatisfactory, and Bill, this goes to your perspective now, and we should point out that Mr. Gross has written all sorts of academic work for the CFA Institute over the years on finance, on the integrity of financial theory. You've lived it, Bill. Is the hedge fund model broken because it's a non-diversified model?
Well, I think it was broken for a long time, Tom. Obviously the hedge fund concept suggested long and short, but it was really one in which managers took a lot of risk.
Yes.
And so when you speak to diversification, perhaps most of those hedge funds were non-diversified in terms of the risk that they were taking. They were taking levered risk and still are. And so to the extent that markets move in an risk-off type of mode, and they have in December and other periods of time, then the hedge fund concept is really an exposure of risk as opposed to anything else, and it needs to be more diversified for sure.
If you're just joining us, William Gross with us, of course, with Janus Henderson. He announces his retirement today, a very young 74, under 75 years old. Of course, this after 4 and 5 decades of work. We continue now with Bill Gross, welcoming all of you on Bloomberg Television and Bloomberg Radio worldwide. Bill Gross, if we look at the investment, the recent investment return in that, you mentioned the German trade, the spread trade with Germany. Did the central bankers get in your way? Are you willing to blame any sense of underperformance on Federal Reserve officials, ECB officials, et cetera, et cetera? These people didn't go by the book, and Bill Gross got run over because they did something new and original.
Well, not necessarily. I mean, they didn't go by the book, and it's up to the portfolio manager to analyze what that new book is in terms of reading. For 5, 6, 7, 8 years, quantitative easing has provided an opportunity for bond investors to take advantage of capital gains. The question became, in terms of Germany versus the United States, what would the effect of U.S. tightening by the Federal Reserve and the ultimate exclusion of quantitative easing in the beginning of quantitative tightening, what would that do relative to what was happening with the ECB? And the spread continued to widen and continues to widen even till today, and that's a very long-term situation.
But Bill, this is critical and critical going forward as you invest your own money, and everybody else wants to know what you feel about central banks that got away from Phillips curve theology over to balance sheet adjustment through quantitative easing, and then onto some set of quantitative tightenings to come. Which of those two was the real harm? Was it the balance sheet dynamics, or was it the death of the Phillips curve dynamic?
Well, I think it's basically both. In terms of the balance sheet, I find it very interesting, certainly in the U.S. with the Fed. The Fed expanded its balance sheet during quantitative easing from approximately $1 trillion to approximately $4 trillion. In a world in which credit in the United States was around $60 trillion. To my way of thinking, back in 2007 and 2008, the Fed was in a highly leveraged situation relative to total credit. It was 1 trillion versus 60 trillion, or 60 to 1. They expanded that and basically equitized their portfolio to 4 trillion, and that was a much leveraged situation. Now, quantitative tightening, reducing that to some extent, although probably going to stop in the next few quarters or so. It perhaps is at a point where the leverage inherent in the Fed's balance sheet and the leverage inherent in the U.S. credit economy is better, put it that way, although not necessarily satisfactory.
So many times I've found, Bill Gross, I don't want to mention names here, but a lot of acclaimed managers in whatever way are shown the door, and then X number of months afterwards, whatever their play was works out like a charm. Do you sense any kind of jump condition coming where yields come up or those spreads normalize? I mean, is it going to be smooth functions over 1 year, 2 years, 3 years, or do we get a jump condition in abruptness to some outcome this year, 2019?
Well, we need to speak to different central banks, I suppose, in different countries. In the U.S., the Fed is at 2.5% in terms of Fed funds. If you assume inflation's at 2, then you've got 0.5% in terms of real interest rates, which, to my way of thinking, is about as high as you can go in a levered type of economy. In the rest of the world, let's just take the ECB and take Japan as well, with their 0% interest rates or even negative negative interest rates in Germany all the way out to 7 or 8 years. There's a very different situation, and things haven't really changed. And I wonder, versus the U.S., what that means for their economy. And as I've mentioned for many times on your program, Tom, the disadvantage, in addition to potential inflation down the road, the disadvantage of negative interest rates and low interest rates in the rest of the world is that savers are disadvantaged, and insurance companies and banks are disadvantaged, and so the savings function is at risk.
This is really important, folks. I'm going to do one more question on this and then switch themes in this generous conversation with Bill Gross this morning, again, on Bloomberg Television and Bloomberg Radio worldwide. We have negative interest rates. This was a huge theme at Davos in the hallways at Bill Gross, a chronic nature to negative interest rates in Europe. It redounds on the U.S. as well. Is that something that goes to a breaking point, or do you have an optimism that ECB in Europe as a political entity can extricate itself from these negative interest rates that don't help savers?
Well, I think it will take time to observe, and haven't we had that for the last 3, 4, or 5 years? And what we've found, certainly in the EZ in Europe with the ECB, is that these rates are just enough to keep growth above the line, and just enough, to keep inflation at 1% to 2%. Japan, for me, Tom, is the petri dish because they've been doing this for 10 or 15 years.
Right.
An economist would have predicted that if the government was buying up all of the debt issued by its Treasury, or if the central bank was buying it, that would be quite inflationary, but it hasn't been.
Right.
And so the quandary going forward is for other central banks, will this behavior create inflation? And in my context, will this disadvantage savers to the point where the savings function and the investment function is severely disrupted?
We welcome all of you on Bloomberg Television and Bloomberg Radio worldwide. Bill Gross announcing his retirement today from Janus Henderson. We're thrilled to bring him to you on Bloomberg Surveillance. Bill Gross, I want you to speak to the savers of America. You grew up Middletown, Ohio. You went out to San Francisco to get as far away from Tom Brady as is theoretically possible. And Bill Gross, you're out in San Francisco. You did war duty in Vietnam, assisting the Tet Offensive, decorated for that, etc. And there was a time there where savers could actually save. You go back to the 70s, it actually worked. You go back to the 80s, it actually worked. I want you to speak right now to our savers on television and radio who haven't gotten a fair deal in the Gilded Age. When do the savers finally get a break and actually get a real return?
Well, to be fair, it's better now than it was a year or 2 years ago. They have a chance to basically stay up with inflation with their money market type of account. But, for a long time it hasn't, and I suspect going forward, if the Fed stops here, there won't be the same advantage, as you mentioned, over the past 20, 30, 40 years, all the way back to when I started in the early 1970s. And so what does that mean? Ultimately, it means to a saver that, they fall behind. Pension funds fall behind. Individual savers fall behind in terms of retirement, education for the kids, et cetera. And it's only been the stock market that has been, the savior in terms of their necessity to build up a nest egg. And many individuals, as you know, don't invest in the stock market. And so, you've got to get the interest rate above the inflation rate in order to give savers, pension funds, insurance companies a fighting chance to take care of their liabilities.
That's a great summary, but do you anticipate that will occur, or is there a permanence to our Gilded Age? The president is going to speak tomorrow night at a State of the Union with a wide perception across all of politics that it's the very narrow haves and a huge body of have-nots that can't get a fair shake, whether fixed income or equity markets. Are we going to shift to some form of real return in fixed income and indeed persist with equity total returns?
Yeah, I don't think so, Tom, or if it does, it'll take a long, long time. I mean, what the Fed did in 2005 and 6 to raise Fed funds to 5% or 3% real or so was to basically break the levered economy. Now, some would suggest that we're less levered now in terms of banks and capital, and we are. But the debt to GDP is still at 250% and climbing, and around the world it's even higher. And so I think central banks have to be cognizant of the fact that a certain interest rate, could break the global economy again. And is that a realistic observation? Yes, but it's also a negative, as we've mentioned, for savings institutions to be able to pay off their liabilities going forward. One of these days, pension funds, large pension funds, will simply say, 3% is not enough. I've basically guaranteed 5 or 6% for my pension retirees, and we're going to need some help here from the government.
Well, we got every other city out there. You name the cities, everything but fancy Newport Beach is underwater. We've got serious actuarial assumptions in America that have gone wrong. How urgent is that, and when do the owners, the pension owners, the people not making the actuarial assumption, when do they say enough, fix this? I don't see that pressure out there, Bill.
I don't see it either, because it's a long-term problem, and politicians and even the public, are want to observe a long-term problem. They tend to look for today as opposed to tomorrow. But I think ultimately it is a problem. How might it be solved? It might be solved by this melding of fiscal and monetary policy that we've seen in Japan and actually in the United States and elsewhere. What does that mean? It means ultimately that the United States could, issue debt to solve these problems, but have the central bank buy it back itself. And is that a negative? Is that a potential harm to the economy? Yeah. Certainly, but what we've seen in Japan is that so far it's working. So ultimately, to me, a long-term forecast, I used to be really negative on this about the $50 or $60 trillion of liabilities with Social Security and healthcare and so on. But the Fed can basically buy it back, and if it's non-inflationary, which is the critical key, if it's non-inflationary, then perhaps they can pull a rabbit out of the hat. I don't think so, but I think they might try.
On Bloomberg Television and Bloomberg Radio, William Gross with us today. He retires from Janus Henderson. We're thrilled that he could join us for this extensive and special conversation. Bill Gross, I want to go back to the theory of the moment. I've got Markowitz's book on my desk from 1962, which is a bunch of fancy theory that you've written about at the CFA Institute. I think of Abby Joseph Cohen and others that have written about the architecture that all of our listeners and viewers rely on. Does that architecture still work? Is the efficient frontier still there? Does the Sharpe ratio still work, and all the other mumbo jumbo, the alchemy of the trade?
Well, I think it does, but it's much less than it used to be, because the financial markets have become so sophisticated with, and not only advanced theories, but with speed trading and computerization and algos and so on. But I think it still works, but to expect information and Sharpe ratios to be higher than 1 or 1.5 or what we have done, I think is a little unrealistic, certainly in an era of low interest rates.
This is then critical, folks. You got to understand this. Out at Pacific Investment Management Company, and I'm sure over at Janus Henderson, Mr. Gross had on his desk before the Bloomberg terminal a Monroe trader, which is how he got his information advantage. Bill, are you suggesting that the information advantage for all of active management, equity, and indeed fixed income as well has to give way to the wonderful John Bogle's passive investment? Please, a comment on active versus passive and the legacy you know from Mr. Bogle.
Well, I'm still a believer in active management, and Jack and I would go back and forth on this. I've always been willing to acknowledge that indexation's primary benefit, and Jack would have said this too, is that it's low fees, and investors in some cases don't pay any fees now for index funds, whereas active management can charge 50, 100, 150 basis points depending upon the risk asset itself. And so, can active managers produce those types of returns to compensate for those fees? I think with interest rates as low as they are, and remember, Tom, that low interest rates basically are the foundation for returns for all other assets, absent euphoria, which we've seen certainly in the past few years. The alpha, the information ratio, the Sharpe ratios, they're going to be much less than they were. And if they are, then active managers have got to lower their own fees in recognition of their inability to return a proper rate of return to their investors.
Bill, in the time that I've got left with you with Bloomberg Television and Bloomberg Radio today, I want to touch upon your philanthropy. Do you still own any stamps, or have you sold it all for medical research?
No, I've got 6 auctions going forward. I've got the bulk of my stamp collection still to go, and it's a little tier, I guess, every auction that I have. But in the past 10 years since I started these auctions, probably $45 to $50 million to philanthropic institutions, right, including a Smithsonian stamp exhibit and post office in Washington, D.C., which is lovely. And so, there's a lot more to come. I still have a few left. I may keep 1 or 2 in the next few years.
One final question, if I can, Bill Gross. I would note the discussion that Gronk may retire from the New England Patriots. I guess Edelman will go forever. But there's this guy, Tom Brady, who you have clearly shown a lack of affinity for over the years. You're not going out on top after a difficult track record at Janus Henderson. Bill Gross, do you suggest that Mr. Brady take the high road and retire today and go out strong?
No, I based upon last night's performance, I mean, Tom eats right. He works out right. He has a belief that he can keep on going for another few years. And as a quarterback, he doesn't need to be fast. He needs to have a strong arm. So, let the guy go. And evidently, and perhaps going forward, he'll be defeated in a Super Bowl and cash in his chips. But he's got a lot of rings. And like I say, I've got a lot of rings too. I'm very proud of total return concept. I'm very proud of the innovative assets that we were able to move into, like mortgages and financial futures and tips and so on, which was really the basis for performance in PIMCO. And so I got a great career. I'm proud of it. Last few years, we'll wipe those off the magic slate and go forward having fun and enjoying life.